wanted to take Tony's question that he emailed in briefly. Tony had a quick question, changing gears now out of spreads, sort of, into collars and covered calls. And Tony wanted to know, can collar trades be structured to receive a similar income potential as a covered call, but with downside protection? Well, in a sense, both have downside protection. In a covered call, if you're slightly in the money, the downside protection is the premium you collected, which contains both intrinsic and some time value as well. But in a collar, you still have protection from the premium you collect, the positive credit you get from selling a call that's usually going to be at or slightly out of the money, and then you're taking some of that away to buy a put option, which sets a floor, meaning that if the stock goes beyond your downside protection, you still can't lose more than maybe 3 or 4% on the position, where you maybe potentially could have larger losses on the covered call. Let's just take our default in the money monthly search, not the monthly picks of the day. I'm just going to use one of our defaults to go out a month. We're going to use the slightly in the money screen. And let me find one that's not too deep in the money. That one's Discovery Communications is pretty good. Not as a good stock. I'm just looking at the returns here. But I like Photronics. It's a lower price stock, and I'm liking what I see here. So PLAB, Photronics, $17.49. We could sell the 18th of February 15 call for a midpoint, hopefully, of around $2.83. So yes, we're $2.50 roughly in the money. We're agreeing to give up our stock for $2.50 less than we paid for it. We get paid a premium of $2.83. Why? Because this gives us a 16% downside protection. Our break even is going to be below $15 per share. The stock needs to fall 16% before we get to that break even point if we get that $2.83 credit. And that's still a return of 30 days of 2.3%. So Tony, let's take a look at this in the profit and loss chart. Standard covered call position. Oh, probability of assigned right now, 87%. 87% theoretical probability that in the next 28 days, PLAB will be above $15. We'd get assigned and make our 2.3%. So we're looking at a 2.3% max potential return on the position with a 16% downside protection. Our percent to break even, and here it's 16%. Now, would I create a collar using this structure? Meaning if I wanted extra protection, was worried about a 20 or 25% potential decrease in PLAB, would I use the same in the money call and buy, say, a 13 or a 12.5 or 12 strike put? No. The reason I wouldn't do it that way is, what do we got? $12.50. We'll go with that. It's going to be about 30 to 40 cents. Well, that's much less than the $2.55, $2.85 we're collecting for the in the money call. But remember, if we're getting that midpoint of $2.83, we're roughly $2.50 in the money, so only 33 cents of that is time premium. I'm taking almost all of that 33 cents of time premium and putting it, let's just get rid of these here. It's extra fives. There we go. And that's what happens. Your profit on that in the money covered call, you were using an in the money covered call, Tony, naturally for the better protection, while still being able to make 2 to 3% return with a high probability of being assigned. A more proper collar structure is going to be selling at or slightly out of the money, looking to generate the best time premium, and then buying the lower strike put at a lower price to keep a positive credit in. So let's take a look here. How would I build one on PLAB? Again, for February. Well, I'm going to have to go right at the money because it doesn't have an 18 strike or a 19 strike, which I might choose for more upside. We're going to have to go right at the money, and the 20 for me is too far out of the money, only 15 cents or so. So we're going to use the 17.5 strike. And yeah, I'm going to use the 15 strike in this case. Now, we showed the example there that the $12.50 put for the collar had a midpoint of 37 cents. But look, if the 15 strike that's not as deep out of the money has action and has a bid of 5 and 15 for 10 cent, this would probably really only cost 5 or 10 cents too. Should only be 5 cents really, but no one's been trading it recently, so that's why you see a wide bid-ask spread here. Again, no guarantee of midpoint. Here, yeah, we're going to check, but I'm pretty sure that if there was any trades today on the 15 strike, the last price was probably 10 cents. All right, but let's take a look at our collar structure now. This is likely the structure I would use, getting about 97 cents for the 1750, 10 cents for the 15. Right at the money, potential for a 5.3% max return if assigned, but there's still a max risk of 9.7%. That's not the structure I do like. This is probably a more volatile position in that case. And I can't do a 17. I don't want to do a conversion, sell them both at the same time. What I mean by that, Tony, is that this is too much risk for me. What I like to see in my collars, even 30 days out, is I'm usually looking for about a 3 to 4% return if assigned, right here, with only taking a risk of maybe 4 to 5% if the stock falls below the put strike price. Think of the covered call again that we had with that deep in the money 15 strike. That gave us a 16% downside protection. The stock had to fall 16% to essentially that break even of 1460, I think it was 1470, somewhere in that range. We'll call it 1465. So we were taking 283 in profit. The stock would have to fall to 1465 on that deep in the money covered call before you started losing money. Now, if it went down to 12 or 13 or 14, you'd start to see some more significant losses naturally. On the collar, that's hindered. But notice in this case that if the stock fell that 12 or 15% and got to $15, you're at a max loss at 9.7%. Where if the stock was trading at $14.50, you're only looking at a 10-15 cent on the deep in the money covered call position. In uncertain markets, the collar is a favorite trade of mine, such as maybe right now where volatility has been increasing. Yes, that does mean I'm likely going to pay more for the put. We're going to get a little bit more oomph from those call positions. And I have the potential, if the stock stays right where it is, to still make that 3 or 4% return that I'm targeting. What else does that mean? That means by having to go at the money in this case for a potential 5.3% return, where our covered call was a 2.3% return, anywhere above 15, I need this to stay where it is or move up a little bit to make the 5.3%. We're probably only at about a 49 or 50% probability of getting a sign on this trade, where we had an 87% probability of making the 2.3% max return on the in-the-money covered call with a 16% downside protection, where the stock would have to fall below whatever it was, 1470 or 1465 before we started to lose money on a position. I'm not saying the collar is a superior structure. I'm saying that looking at these two right now with what came up on the search, if I can get that midpoint and that 2.3%, if I was trading PLAB, just looking at the numbers, I might be more tempted to use the in-the-money covered call at the 15 strike if I felt good about getting that 280, 283 midpoint for that 2 to 2.3% return. Even though this collar is offering a 5.3% return, the stock only falls, 10%, 11%, or 12%. I'm at the max loss of 9.7, where I'd still be at a profit or just a small loss with the deep in the money covered call because of that structure. Now let's go to long collars very quickly. Let's see here, other strategies. Take out calendar call for the time being. We're going to add long collar to our menu of our 23 available strategies. Let's go ahead and save that. And let's go ahead and go into our long collar search. I want to show you basically what one of my trades, my preferred structure for a long collar would look like here. Oh, these are all pretty close, but they're all lower prices. PLAB is not in here, but look, here's another $18, $17 stock. Oh, we don't want that. We're looking at the conversions. That's why it looks pretty interesting. I'm going to go with the initial value standard collar search. Perfect. And let's see here. Now that one's pretty good. 1-to-1 risk reward ratio on the first two. I kind of like it. Devon Energy 46.12. Selling the, of course, it's down 251 today. Everything's red today, isn't it? Anyway, sell the February 47 call for about 259, 260, and buy the February 44 put. Would get a net credit of around 60 cents at midpoint. So this is probably 265, and this is probably about 210, something like that. So we get about 60 or 220. We probably get about 60 cents credit. The risk is 3.3% if the stock's trading below 44. It's about a 5% decrease from where it is now, with the potential to make 3.3% if the stock stays above 47 in 28 days. That is a structure that I like to see in the collars, closer to a 1-to-1 risk-reward ratio. Yes, this one's a little bit more out of the money than I would like. I'd probably like the stock to be closer to 56.50 or 56.75 when selling the 47, close to at the money. What that would do is give me a little bit more premium and have a lower cost here on the put, but I'm not saying the risk reward would be better. This is a 1-to-1 risk reward ratio. But again, going into the probability discussion and the expectancy of profit, Tony, this is probably only about a 44% probability that the stock will be above 47 in 28 days. But that's the structure that I like. Similar potential return to an at slightly in the money covered call position, not a speculative out of the money where you'd gain intrinsic. Similar percent return, max return if assigned. Controlled risk, 1-to-1 risk reward ratio. Most of mine would usually be around, let's say, 2.8% return if assigned, 2.9. I know it's not, it's just a little bit below 3, with the max risk around 3.6, 3.7%. Now, I think that's what my average has been over the years trading the standard collar positions, is really close to that. And that's kind of what I like to look for. Let's take a look at it just to make sure that I'm even in the ballpark here. Suppose it could be low. I said 46 to 44. Let's see our probability here. On our February 47 call for Devon Energy, 45 point, oh, sorry, probability above. Yeah, I'm sorry, I was right. 45.5%. So yeah, I said 46 to 44. I was kind of right there in that range. So perfect. Yeah, that's about what you do. You're giving up the expectancy, Tony, of a potential return if assigned, but you've got a controlled risk for an unexpected event. If the stock falls 5, 6, or 7%, you're only going to be able to lose 3%. Fair question, Jim, or fair comment, Jim. He says, now compare it to the in-the-money covered call you might use for Devon. Let's try the 44 strike. Not as deep in the money as the other one, Jim, but let's go ahead and give it a go. Take out our collar position here. We know we're at a 1-to-1 risk-reward ratio with a 45.5% probability of making that 3.3% return in 28 days with a controlled risk of 3.3%. February 18th, 1 month out, same expiration. In the money 44 call, about 420. At midpoint, let's go ahead and put that in. Okay. And what do we have here? Now, this is interesting. If we get midpoint on the 44, we have a potential to make a 5% return. We're protected down to 41.92 in this scenario. So that's 15%. I'm sorry, no, it's 5. It's less than 5 points down. It's 46 here. We'll call this 42. So it's, yeah, just a little bit less than a 10% downside protection in that case. It's pretty decent, though. So in other words, the stock would have to fall about 10% down to 41.92. We'll call it 42 before we start losing money on the trade. Whereas in the collar we built, if the stock fell just 5% to below 44, we'd be risking 3.3%, near the full loss of 3.3%. We could always restructure and rebracket the collar, just like you can do on a credit spread, and restructure it if it starts to move against you. That's true. But I like the structure of that collar, 1-to-1 risk-reward ratio. But the in-the-money covered call, Tony, you can see here, it gives you that almost 10, 11% downside protection, potential to make a 5% return on the position. And I wouldn't, again, take the in-the-money covered call and then collar it for an extra loss. If I'm using the in-the-money covered call to hit the return I want while getting the protection I want for getting both the intrinsic and the time premium, I'm not going to take away from that time premium. Although this one's pretty darn nice, isn't it? It's a $2.08 time value on a 28-day out option. Ooh, is that because of volatility, or is that because we have earnings coming up on 2/15 before February 18th expiration? So in other words, I wouldn't trade a covered call on a stock that has earnings between now and expiration, but that's why that premium is inflated. The collar might not be a bad idea. Earnings 3 days before expiration, impress, and the stock moves up. Got a better chance of getting that full 3.3% return. But if we're wrong and the stock falls 12 or 15% from poor earnings, hey, we'd still only be at a loss of that 3.3%. So, Tony, those are my thoughts on the covered call versus the collar. In the money, covered call does give you a good downside protection with still the potential to make, as we saw, a 2 to 3% return on stocks that maybe don't have earnings between now and expiration. The long collar search, since we have protection locked in, we didn't remove that stipulation in the long collar trade because you have the protection already there. But naturally, if we went into our search, our default search here, go to fundamentals and not between now and expiration, we don't have Devon anymore. We do have Newmont, almost a 1-to-1, a 3.9% return if the stock's above 65. With only a 4% maximum risk. And you see ranges here of that 3% to 5% risks. Here's another almost 1-to-1, 4.8 to 5.2. But yeah, this one's 3.8 to 5.6. That's a pretty high one here. Oh, that's why. Okay, it's a 10-point spread. That's why the risk is higher. Look at it, a good structure here. These ones here, the Wells Fargo ones I kind of like. 53.67. Selling the 55 and buying the 50 for either the 18th or the 11th. Yes, you take a higher risk of 6%, but you're still looking to make 3.4%. Where's our probability, though? Yeah, 37, 39%, 40. That's what you're giving up with the collar for the comfort of that extra protection in case there's a 10, 15% sudden decline on the position unexpectedly. So, Tony, I hope that answers your question there on the collars versus the covered calls.